There are a lot of ways you can be tax efficient with your pension withdrawals when you have access to your pot. But today we're not talking about tax efficiency in the normal sense. We're talking about HMRC overcharging you on your initial withdrawal from your pension pot and what you can do about it. I've seen this happen to a lot of my clients. It frustrates them and me a hell of a lot, so I wanted to talk about it today because in many cases, it can cause some genuine issues for people based on their income needs and tends to throw a spanner in the works right off the bat during our financial planning conversations. Okay, so what is actually going on here? Well, I'm sure many of you have been subject to emergency tax at some point in your life. This tends to happen when certain circumstances change surrounding your income. Oftentimes, it's you getting a new job or moving from employed to self-employed or vice versa. So how does this apply to your pensions? Well, when pension funds are crystallized, or in other words, you start drawing down from your pension pot, up to 25% of the crystallized amount can normally be taken tax-free as a tax-free lump sum. Any amounts in excess of that 25% lump sum are then taxed as non-savings income under the PAYE or pay-as-you-earn system. In practice, however, when you begin the drawdown process, the amount of tax deducted will often be incorrect because the pension provider normally has to apply a temporary tax rate or tax code in a similar way to what a new employer would have to do if they didn't receive your P45 once you moved from a previous job. The difference here, however, is that in many cases we're dealing with large sums of money, especially if you elect to take the maximum tax-free lump sum of 25% of your entire pension pot as your first withdrawal. And this is where things start to get a bit more messy. In the majority of cases, schemes paying out of a single or ad hoc withdrawal or making the first payment of regular pension will use an emergency tax code on a month one or M1 basis. So the chances are your tax code in a scenario like this will be something along the lines of 1257L M1. What this tax code means for tax calculation purposes is that it won't take into account any previous payments made in the current tax year. Income tax is calculated using 1/12 of the standard personal allowance and 1/12 of the basic and higher rate tax bands, and anything above that is subject to additional rate tax. In other words, this tax code assumes that the payment you've received will be a recurring monthly payment for the rest of the year, and therefore will apply tax in line with this. You can probably see why this can lead to a pretty soul-crushing tax bill as soon as you access your hard-earned retirement income. But let's get into the specifics here with an actual example, because that's a lot of theory. So for the 24-25 tax year, on a tax code of 1257L, this will give you a tax-free personal allowance amount of £1,047.50, which is 1/12 of the £12,570 annual personal allowance. And then the rest of the payment will be taxable. So let's take a very common kind of example that I've seen play out time and time again. You're wanting to draw down a £40,000 income for the whole tax year. This means that £10,000 of this can be taken as a tax-free lump sum. The remaining 30 grand will be taken as a taxable lump sum right away. So let's start with how this should be taxed. We'd start by subtracting our full personal allowance of £12,570, leaving us with a taxable income of £17,430. From there, it's very simple. We fall within the basic rate band of tax, so we apply a 20% tax, leaving us with £3,486 of tax payable on the drawdown. As an aside, it's worth noting that although private pension drawdowns are taxable as non-savings income, just like how your salary would normally be taxed, national insurance is not due on private pension income, even if you're not of state pension age. So from our £40,000 drawdown, we'd be left with £36,514 for an effective tax rate of under 9%, which is obviously great. But it's time for HMRC to complicate things. This is how things will likely play out in reality. You still get your £10,000 25% tax-free lump sum, but the remaining 30 grand will be taxed as follows. £1,047.50 will be tax-free from 1/12 of your personal allowance, and then applying 1/12 of the basic rate band gives us £3,141.67 of income tax at 20%. 1/12 of the higher rate band gives us the next £7,286.67 at 40% tax, leaving us with the remaining £18,524.16 to be taxed at the additional rate of 45%, leaving us with a grand total of £11,878.87 of income tax to pay, or an effective rate of just under 30% of our 40k drawdown, 3 times as much tax as we should be paying, for a net income from our 40k drawdown of just £28,121.13. This is obviously far from ideal, but the good news is that this is a temporary issue. You will get this excess tax payment back. But before we talk about how, the first takeaway from this video is to consider this when making your first drawdown, and how this affects your short-term needs. i.e., if you truly need a certain sum of money right away in your first month of drawing from your pension, you should weigh up whether it's worth drawing down a larger amount to the point that even if the emergency tax is applied, you'll still meet your cash flow needs. The downside to this may be that this may truly push you into the higher or additional rate tax band for the year, making the drawdown actually non-tax efficient. So like I said, this should only be done if you truly need the specific sum of money right away. So how do we get our money back? As soon as you've seen that you've been emergency taxed, one of 3 forms should be submitted to HMRC based on whether 1, you have withdrawn your full pension and have no other income for the year, 2, withdrawn your full pension and have other income for the year, or 3, withdrawn a percentage of your pension and no further withdrawals are planned for the year. In this case, we'll be using the third option. I've also linked all of these forms in the description, which you can submit directly to HMRC. The reason different options exist here is that if you have no further income expected for the year, HMRC will issue you a refund and change your tax code going forward. Whereas if you do have other income expected in the year, HMRC will oftentimes issue you with a tax code that will effectively apply the tax refund to offset future tax payments and then issue an actual refund for anything in excess of this. An alternative to this, and something that I tend to do for my clients and recommend that you do in addition to the form, is to give HMRC a call and ensure that everything is actually in order going forward. It is a frustrating but worthwhile task to do to make sure that your tax code is correct and that you're actually getting all of your overpayments that are owed to you. The last point here is that in some cases you can avoid this altogether. The way around this would depend on your pension provider, and some simply require you to reclaim the tax back from HMRC as we discussed. But others will get the tax code updated for you if you either provide them with a valid P45 for the tax year in question, and or if you contact HMRC prior to making the withdrawal and ask them to reach out to your pension provider with an appropriate tax code. This is definitely worth giving a go to save yourself the hassle and the temporary hit to your income during the first month of retirement. I fully appreciate that this is a frustrating and confusing process, so please feel free to vent your frustrations and ask any more questions in the comments below, and I will get to all of them. Please also feel free to reach out to me using my email address in the comment box if you have any more detailed questions you'd rather not share in the comments. In most cases, this is something outside of your control, so my advice would be to stay aware of what is going to happen and control what you can control to maximize your pension's value and longevity throughout retirement. I've put together a video with 7 pension tips that I think will really be helpful to a lot of you with this, so please give it a watch. Anyway, I hope you found this helpful. If you did, then please consider leaving a like, and I'll see you in the next one.